Hi traders, you are welcome back to the Forex Geek channel. In this video, we're going to be diving into one of the most powerful trading strategies out there, which is the liquidity sweep trading strategy. Okay, it's just going to be a step-by-step process. It's going to be real quick but effective at the same time. So if you are new to this strategy, or if you've heard of it but want to understand it better, then you are in the right place. Okay, liquidity sweeps are one of the most effective ways to understand the market's inner mechanics. Professional traders often use this to track institutional market movements and predict where price is likely to head next, right? So in this video, I'm just going to be walking you through this strategy in detail, step by step, so you can start applying it to your own trading. All right. But before we dive in, don't forget to hit the like button if you find this video helpful, and subscribe to the channel for more trading insights. Okay, let's just start with the basics. What exactly is a liquidity sweep? Now, at its core, a liquidity sweep occurs when a large player, usually an institution or a market maker, moves the market to a specific area where a lot of traders, or rather a lot of stop orders or pending orders, are clustered. All right. So these large players are looking to grab liquidity, hence the term liquidity sweep. To understand where the terminology came from now, right? By triggering these orders, they can push the price in a specific direction, filling their positions and creating a price movement that you can potentially profit from. Now, you might be wondering, how can I spot a liquidity sweep? That's exactly what we're going to be talking about next, right? So the first step in executing this strategy is identifying where liquidity is likely to be. Now, these are the zones where traders have placed their stop losses, limit orders, or other types of resting orders that can be triggered by a price sweep. So there are two main types, or rather, there are two main areas to look for, right? The first is the previous high or low. So liquidity is often concentrated at key swing points, where that is places where price has recently reversed or failed to move beyond. All right, that's why we say recent swing highs, recent previous highs and lows, right? Previous highs and lows. Okay, so this could be just gonna extend this particular high. So this could be, previous highs and lows or key supports and resistance levels. Then in terms of round numbers, many traders place, orders at psychological levels, like round numbers, like 1.1000, 0.8000, 0.9000, 1.3000, etc. And institutions know this. So these levels are often targeted in a liquidity sweep. So what you need to do is look for these areas on your chart. If price is nearing one of these levels, there is a good chance that the market is preparing to make a move and sweep liquidity. So once you've identified these liquidity zones, the next step is to wait for the sweep to happen. Now, this is where patience comes into play. You want to wait for price to break through these liquidity zones, usually with a sharp move, or a wick, which indicates that liquidity is being triggered. Now, when price hits these zones, you'll often see a rapid spike in movement as stop orders, get triggered. This spike, okay. So this spike is a clear signal that the sweep is taking place. So I'm just trying to see if we can find a very, very great example. Okay. Well, in this area, in this zone, we had sort of a spike below this support, right? And you can see just shortly afterward, we had a reversal. And this is areas where traders might have set their stop losses and set their pending orders, and you can see what happened. Okay. So at this point, you're looking for few key signs that will confirm the sweep, such as a sudden strong price move in one direction, typically a sharp wick or large candle. Then you also notice increased volume during the sweep. Let's just add the volumes indicator, right? So you will notice increased volume during the sweep, showing that there is strong institutional involvement. So once you've identified that a liquidity sweep is happening, the next step is entering the trade. So here is where it gets interesting. After the liquidity sweep, you'll often see price reverse or consolidate, especially if the market was targeting a specific level. So you want to enter the trade in the direction of the market's original move. If the sweep happened to the upside, now price is reversing downwards, may be a good signal to go short. Conversely, if the sweep happens to the downside and price starts to show signs of upward momentum, it could be a signal to go long. So the key here is to wait for confirmation of a reversal after the liquidity sweep. A good confirmation might be a strong candlestick pattern. For example, we can see how we had this bullish engulfing here, right? So, like any strategy, risk management is crucial. You don't want to blindly jump into a trade just because a sweep occurred. So instead, you should set clear stop loss levels based on recent market structure or a key level just beyond the liquidity zone that you are targeting. For example, if the sweep happens at a previous low, you might set your stop loss just below that low. Okay, give it some pips. All right. This ensures that if the market does decide to reverse against you, your loss will be limited. Another important risk management tool is your position size. Ensure that you are trading with an appropriate amount of risk relative to your trading capital. A common guideline is to risk no more than 1 to 2% of your account balance per trade. Now, when it comes to taking profits, your target should typically be a key level where price is likely to stall or reverse again. This could be the next liquidity zone or a recent support or resistance level. You can also use trailing stops to lock in profits as the price moves in your favor. So this allows you to stay in the trade longer if the price continues to move in your favor, while protecting some of your gains if the market reverses. All right. Now, as with any trading strategy, practice makes perfect. Liquidity sweep trading takes time to master. Okay, it's important to backtest this strategy on historical data and use demo accounts to practice before trading live with real money. The more you familiarize yourself with how liquidity sweeps unfold in different market conditions, the better you'll get at spotting high probability setups. And that is a wrap on our liquidity sweep trading strategy. By understanding how liquidity sweeps work and knowing how to spot them, you can position yourself to trade with the market's natural flow, catching moves that most traders might miss. If you found this video valuable, please hit that like button and don't forget to subscribe for more trading strategies, tips, and insights. Thank you for watching, and I'll see you in the next video.